5%. I always say have at least 5% of your net worth, around 5%, not too much more, of physical gold in your possession. You start there. And then I toggle between 0 and 20 the allocation to gold, which includes physical gold and miners. So I'm about halfway there.
How's it going, everybody? My name is Antonio, and I am here today for some resource talks, but also some macro talks with Michael Pento. Michael's an American economist and a researcher, as well as the founder of Pento Portfolio Strategies. Who's not going to be participating in this talk, though, is your financial advisor. This conversation will be general and impersonal in nature, and it will include a lot of forward-looking statements and hopes for the future and stuff like that. So it's in your best interest to be skeptical and double, triple check whatever's being said on the internet in general. And in the end, always take your own decision. That all said, Michael, thank you for investing the time in me, sir.
Thanks for having me on, Antonio.
Pleasure is all mine, of course. This is the first time that we are talking, but I'm just going to assume that people know who you are. So let's kick it off with sort of an obligatory question here that I ask for first time visitors, which is your I call it a 40,000 foot view question. So if we, let's say, get on a jet together or whatever goes 40,000 feet up in the air, and we look at the state of the global economy from your perspective, from your lens, what would we see?
Well, we just came off of the greatest experiment in monetary madness in the history of mankind. The central banks' balance sheets are now about 47% of GDP. They normally are around 8% of GDP. So that should get you on the edge of your seat. The greatest distortion in interest rates and money printing caused the greatest accumulation of debt ever in the history of mankind, which led to what I believe is the greatest bout with global inflation. You've had, much more difficult bouts with idiosyncratic inflation for, Hungarian Tango, for example, or the Weimar Germany, but the developed world never had concurrently inflation rates that were 40-year highs or more, actually historical highs altogether. And then in response to that inflation, you had some of the most hawkish monetary policies to pop the asset bubbles that were created from all that debt that was taken out and the great distortion in interest rates. So we're on the edge of a cliff, in my opinion. I have a very arcane and robust model that I created called the inflation deflation and economic cycle model. So it keeps me from getting overly bearish when the market isn't ready to crash. So I'm ready to get, I've been ready for several months now to add to my shorts. I have very few shorts in the portfolio. I'm very defensive, though. I have lots of treasuries. I have defensive sectors like utilities, bond and bond proxies, I call them. But I'm not aggressively short. I'm waiting for my model to signal when it's time to happen. And the reason why I think we've been held in abeyance for not going over the economic cliff, proverbially, is you have things like in early March, you had four banks starting to unravel. The Fed launched something called the Bank Term Funding Program, which printed $400 billion in 2 weeks. You also have this debt ceiling standoff, which is a draining of the Treasury General account, which adds money to the system, reserves to the banking system. So I think that's almost over with. I think the resolution of debt ceiling will be a fiscal cliff in conjunction with the monetary cliff that we've gone over. Don't forget the Fed started hiking rates in March of 22, so we have the late effect. So whereas right now people might say, oh, you're a Cassandra, you're calling for the end of the world. I'm not calling for the end of the world. I'm calling for a disinflation to a deflation and a recession and depression. The timing of that is crucial. And then on the other side of that, I think we'll start waxing towards something what I call either intractable inflation or intractable stagflation, which I think is the next cycle after the deflationary cycle we're heading into consummates.
Well, can you put some timelines on that as well? Because you said timing is crucial here, but does your model involve any timelines?
Well, no, the model isn't like, I could tell you, June 30th is when the next deflationary scare will come. It just, I look at things like credit spreads. I look at things like the 210 Treasury spread. I look at high yield spreads. So, I mean, I'm not going to give away my entire model on this program, but it's when the market is ready to start to, in advance, ready to go over that cliff. In advance, I'll know that because of my model, and I'll react because credit and credit spreads, in particular, will lead the stock market. So the equities follow that dynamic. So I'm not going to get ahead of myself, but it wouldn't surprise me, if you want me to guess, it wouldn't surprise me that after we solve the debt ceiling crisis, that you'll have QT on steroids. So you'll have the ongoing 90 billion per month QT program, in addition to refilling the Treasury General account. And I think that will precipitate a tightening of global financial conditions. So you're looking at something maybe, June or July. That's what I think should happen. But again, I don't operate my portfolio management on feelings. I look at the data and the math.
Though, if we look at what those raising interest rates have resulted in, though, is that because you mentioned the filling up of the Treasury General account, TGA, bank deposits have decreased significantly year over year, but the loans that those banks have on their books have actually increased. So while we also see a spike in the percentage of banks that are making it harder, sort of tightening their commercial and industrial loans standards, if you will, which has resulted in weaker demand for those commercial loans as well. So how does that tie in that previous view of what you just told me?
Well, if you look at the percentage of commercial banks tightening lending standards, it's now at 47%, and it continues to rise. That's a recessionary level. So banks are, without a doubt, tightening their lending standards, and the demand for credit isn't there either because we have an over-leveraged economy. As a matter of fact, if you look at the debt, the total non-financial debt as a percentage of GDP today, it is higher than it was at the start of the global financial crisis. So we have more debt outstanding. People say, well, it doesn't matter because it's all in the hands of the government. Well, it kind of does matter because the government doesn't have any money. The government has to sell bonds to the public and take money out of the hands of the private sector and put it in the public sector. But it's also not true that it's all in the government sector. We have a record amount of corporate debt, business debt as a percentage of GDP. So we have the most over-leveraged economy in the history of mankind, as I started the program off with. And if you look at some of the asset bubbles they created, we have a record bubble in equities. It was, if you look at the total market cap of equities as a percentage of GDP, the average is around 80%. You go back through history. It's also known as the Buffett indicator. Well, that hit 200% of GDP at the start of 2022, Antonio. So these are prima facie. I'm going to give you prima facie evidence as to the massive bubble that this debt, the distortion of interest rates, which led to a record amount of debt, which led to record inflation, which engendered record asset bubble. So there's your equity bubble. Now, there were $17 trillion worth around the world of negative yielding debt. Prior to 2014, the thought of that was completely anathema. I mean, no one would borrow money and get paid to do so. This doesn't happen, It doesn't it never happened before in the history of mankind. So that's another prima facie evidence. And if you look at the real estate market, if you look at home prices as a percentage of income, they're higher, much higher today than they were in the prior apex in 2005. And if you look at the debt service cost, so the mortgage and interest cost as a percentage of income, it's the highest it's ever been. So these bubbles are out there. And then you have the fastest rate of change in interest rate hikes ever. We went from 0 to 5% from March of 22 to now we're sitting in late May. 5%. In 2004 to 2006, we went from 1% to 5.25%. Now we went from 0 to 5.25%. 5.1 if you look at the effective Fed funds rate. So basically the same. But in half the time, in addition to QT, which was not happening in 2004 and 2005 and 2006. And I'll refresh your audience and you, I'm sure you remember that in 2006, everything looked great. Fed stopped hiking rates in the summer of 2006. A year later, the real estate market started to fall apart and the stock market topped out. So you asked me about timing. I mean, Who cares? I'm patient. I just gave you the setup for where we're heading. It's not my imagination. I don't like to just to be bearish, just to be bearish. We had a record distortion in interest rates and money supply growth, which engendered record high inflation and record asset bubbles that occurred concurrently. 2000, we had the NASDAQ bubble. That was it. There was no real housing bubble there. There was no real bubble in the bond market. 2008, you had a bubble in real estate market, but there was a real big bubble in the stock market or the bond market. Now you have all three. You had all three existing concurrently. And that has caused the fastest rate of change in tightening of monetary policy. 80% of global central banks are tightening interest rates recently. 80%. So there's consequences. There's a delay in the consequences because of the TGA, because of the money, the M2 money supply, Antonio, rose by, I think it was a 42%, no, 47%. All these numbers in my head. 47% increase in M2 money supply in the previous 2 years. Okay, that has never happened before. The average growth rate in the M2 money supply is before COVID was about 5%, not 42% in 2 years. So you have a lot of exogenous buffers that are happening, including the draining of the TGA, the BTFP. So that's what's held the collapse in abeyance. So I don't know how long that's going to last. I think maybe June or July. I don't know, but the inevitability is now that the balance sheet of the Federal Reserve is now shrinking again. Reserves are leaving the banking system. 4 banks have failed. The trouble in the banking system, I think, is very clear. You just can't pay depositors 5 basis points when they can get 500 basis points from owning a T-bill. That's your basic problem. Of course, there's other problems because their assets are eroding. Their real estate assets are eroding in value. We haven't even seen that capital crunch hit yet. That's coming. But you're having what some people have called, Jim Bianco calls it a bank walk. I like that term. Not a bank run, it's a bank walk. It's a bank run. It was a bank run for Silvergate and Silicon Valley, but it's a bank walk from everything else. People are saying to themselves, I can get 5% in a risk-free T-bill, or I can get 5 basis points in a bank. So banks have to either raise their deposit rate to match T-bills, but if they do that, they're paying more to their depositors than their assets are collecting in many cases. So mortgage rates were high 2s, low 3s for the best part of the last decade. So that they can't match T-bills, so they're just going to watch their money walk out the door, which is a drain on reserves, which is also what QT is doing. So you see the problem.
Yeah. Now, you mentioned a couple of things that I wanted to touch upon, but it's also tough for money market funds to find good places to put money in right now, right? Also, with higher interest rates and ever more challenging economic outlooks, it would make sense if the parties that deal with large nominal sums of money, I guess, would make use of the reverse repo program, right? And that has been happening at least a little bit already. So, I mean, do you expect money to continue flowing out of the banking system and specifically into the reverse repo? Or what does that mean for the government?
Well, reserves are being sucked up by the Fed, the reverse repo system, but the reserves are leaving the banking system through QT, 90 billion a month. So there's less and less reverse repo happening. The Fed is draining all that out of there with the QT program. So yes, I mean, I expect reserves to leave the banking system for a simple reason that they don't. Listen, I made a very simple calculation myself. I had a lot of money at a certain bank. I asked the bank manager, why am I going to accept 5 basis points? He said it's that on a demand deposit, not a time deposit. Time deposits are a little bit better, but I can get a 0 to 3 month T-bill for 5.5% right now. So the calculation is simple for me, and it's for a lot of other people too. Leave the banking system where there's more risk. Don't forget, my deposit was above the FDIC insurance level. But I can move that money to a money market mutual fund at a brokerage firm with all kinds of insurance and guarantees from the full faith and credit of the government and get over 5%. No brainer. It's a no brainer.
Right. when I'm thinking about something that Brent Johnson said, because he's the reserve, so the reverse repo is sucking in basically dollars. What would it happen if the debt ceiling, when I assume it's inevitable for the debt ceiling to get raised, when the debt ceiling gets raised, wouldn't that suck in even more dollars and make it even, bullish for the dollar over the short run, because it adds, demand pressure on the dollars?
Well, it's a drain of reserves from the banking system. When they have to fill up, when the Treasury has to fill up the TGA, they're going to issue bonds. They're going to collect money from the private sector, from bonds, reserves, and those reserves are going to be parked at the Federal Reserve. And that's a drain of liquidity from the banking system, from the financial system. And I think that is bullish for the dollar because it could lead to a liquidity crisis.
So with all that, do you think that the economy can sustain another rate hike later this year? Because it sounds like if we go through another rate hike, it would make everything worse, everything that we've spoken about.
My own opinion is, you listen to Jim Bullard today, his base case is 2 more rate hikes. And then if you look at other reserve officials, they say they're done. They're at a pause. Cash Carry said that June would be a pause. I'm on the pause camp right now. But the damage, Antonio, the damage is already done. They went from 0 to over 5% in a little bit over 1 year. That has never happened before. And QT is continuing alongside that. So it's a matter of time before we have another more banking system failures. And I believe we will have another credit crisis. Now, again, the timing is opaque, but I'll have a model that will lead me to where I need to be as far as when to get bearish and when to stay defensive or when to get less defensive.
But if the problem is liquidity in the banking sector this time around, which was not the case in 2008, as far as I understand it, though I was like 10 at the time, so I was busy collecting Pokemons, not following the economy.
I don't want to hear that.
No, but it's so if the problem right now is liquidity, which was not exactly the case in 2008, isn't that easily fixed by the Fed just cutting interest rates?
Well, this is why I have an inflation deflation economic cycle model. So you say, well, first of all, let's just take you back to 08. I was actually, on television in 08 on the Kudlow program, not to give away my age, while you were I think you were nap time in the kindergarten. No. I'm joking. You're a little older than that. But listen, in 08, we had an inflation rate that wasn't really that much of a problem. We had a housing bubble, but we didn't have a 9% CPI rate. It was much lower than that. So the answer to that question is, could the Fed reliquefy the banking system and cut rates? Don't forget, the Federal Reserve under Ben Bernanke cut rates in the summer of 2007, started cutting rates from 5.25%, and he hit 0 by December of 2008. Was it a good time to start buying stocks in the summer of 2008 after he went almost to 0? He was almost at 0 at that point. Was that a good time to buy stock? No, it wasn't. So, it's one thing for the Federal Reserve to act, and monetary policy works with a lag. So I have somebody I follow too is promulgating the idea that since the Fed paused, that it's a great time to go long stocks. Well, the Fed paused in 2006. Was that a very good time to go long the stock market? And the answer is no, because again, monetary policy works with a lag. But back to my point. What if the Fed, let's just say we have another nascent liquidity crisis in the summer of 2000 this year. And the Fed is at the current CPI is at 4%. We know that, right? 4%, which is, when I went to school, that's twice the Fed's target level of 2. And the Fed says at that juncture, let's say the CPI at this time is just above 3.5%, which is where I think it'll be this summer. And the Fed says, okay, we're going back to ZIRP and QE. What do you think would happen to inflation? I mean, my visceral reaction would be that inflation would run intractable, much higher than ever imagined in this nation, because the Fed would admit that, listen, we can't have. I mean, the Fed funds rate just got above inflation. If you look at the PCE, personal consumption expenditure price index, just barely above inflation rate. A real interest rate. Imagine that, a real interest rate just happened. And then the economy and the financial markets collapse. And basically, you're communicating tacitly that we can never have interest rates that are real. So you'll have a negative real Fed funds rate. Nominal rates will be pushed down to the floor, and we're going to start printing money and reliquefying the banking system. You're going to have asset bubbles like we've never imagined and intractable inflation. I don't think that's what the Fed wants. So what I'm trying to tell you, Antonio, is that it's much more difficult to lower interest rates when you've already jumped the shark on inflation.
Well, but is there anything that the Fed or the government, whoever out there, policy, whatever it might be, could do to keep stability in the banking sector, which I guess is important, keep full employment, which is part of the dual mandate, right? And at the same time, defeat inflation? Like, is that possible in any imaginable way, in your opinion?
No, you can't do both things. I think the odds of that are virtually zero. You just can't do both. You can't fight inflation, which is tightening monetary policy and draining reserves from the banking system. And like I said, M2 money supply jumped by 42%, 47% in the previous 2 years prior to 2023. You have to drain that money. It's sloshing around the banking system. You have to take it. You have to take it away. It means you have to get. Here's another example. The Fed's balance sheet went from $800 billion to $9 trillion from 2008 to 2022. Antonio, you have to take that. That's high-powered money. So it's notes and coins in circulation and bank reserves. You know that, right? That's called high-powered money. That's called the Fed's balance sheet. And it's called high-powered money because that's the basis of the fractional reserve system. I know you don't need reserves to make loans anymore. I get that, but you do need some money to meet liquidity requirements and Basel III requirements. So it's BS to say, oh, you don't need reserves. No, you do need reserves, because if I deposit $1 million and you loan out my $1 million and I ask for 100,000, you don't have it, and you're bankrupt. Okay, your bank is.
What do you think that percentage is? Sorry, I'm sorry for interrupting, but it used to be 10%, right? For you to. So what do you think that percentage is now?
I think it's like 2%.
Oh, wow.
It's very low. It's very low. So, but listen, that's all on the heel. You know, you have a fractional reserve system, a debt-based monetary system, and the Fed in its wisdom said, hey, there's no reserve requirements any longer. Isn't that wonderful? And there hasn't been one for a long time. You know, you could sweep, not to get too arcane, but you could now, for decades now, you could sweep a demand deposit into a time deposit. They call it automatic sweeping. And there are no reserve requirements for time deposits. Ooh. So, you know, you look at it's some people don't, like me, I don't even like the fractional reserve system, but there doesn't even really exist anymore. It's just like, does the bank have enough money to meet liquidity requirements? And ask Silvergate and Silicon Valley Bank if they have enough liquidity to meet demand requests for money. No, you don't. And then you're forced to sell assets, which means your capital goes away. So.
But what if they start lowering rates? Which, I mean, if the Fed is not lying to us, they're not going to soon. Maybe they're going to keep it there so higher for longer possible. But what if they start lowering rates, but doing QT, so loosening into one end, tightening on the other end? It's like that normally doesn't happen. But what if they pull it off this time?
If they lowered rates and continue with QT, I don't know. You have a lot of what ifs. I mean, I guess that's a possibility. It sounds very contradictory to me. But I don't think if you continue QT, an aggressive QT, I guess what I'm trying to say is you have to decide what you want to do. Do you want to fight inflation, or do you want to reliquefy the banking system? Continuing on with $90 billion a month of QT, but lowering interest rates on the margin isn't going to help very much, not in the short term. We know from history that the Fed went from 5.25% to 0 in 2000, and from 2007 to the end of 2008. and it did not stop the meltdown. It just didn't happen fast enough. It wasn't able to reliquefy the banking system fast enough. So I don't think a continuation of QT and a marginal reduction of interest rates would help.
Okay. You almost
At the end of the day, you have to decide what you want to do. Do you want to fight inflation, or do you want to reliquefy the banking system? Those two things are absolutely contradictory to each other.
Right. I think it's one of the Fed speaking heads who said that they might want to try something like that. I think Joseph Wong has also been talking about it, but it's interesting. I've been getting mostly the same reaction from most people that have asked that question of, hey, what if? But you're also right. There's a lot of what ifs there. Well, what then are you doing with your own money? You cannot tell me everything, but what's sort of the broad picture if I look at your portfolio from that 40,000 foot view?
Yeah, no, I'm not going to tell you, specific weightings, but obviously for compliance reasons, because they change. I run an active portfolio, but I'd be happy to share with you the portfolio. As I said in the start of the program, it's very defensive. We have some gold. We have lots of bonds getting that yield, both short duration and long duration bonds. More on the short duration end because I'm getting more interest on short duration, and I think the Fed will eventually have to acquiesce and lower interest rates. But they'll do it out of duress, in a panic. They're not going to do it proactively, Antonio. That's not going to happen. I have bond proxies as well. Utilities I have in there. I have some defensive stocks too. And I have a few shorts. Very few at this moment. I think we're about 4 or 5% of portfolios in short positions, and I would love to increase that. I'm just not going to do it until my model says it's time to do it, and it's just not time to do it yet. I happen to think after the debt ceiling gets raised, and I think it could get raised under, again, duress, because I don't think the Republicans are going to raise taxes and not cut spending, and I don't think the Democrats are going to allow for really any significant spending cuts without big tax hikes. So there's a lot of work to do in about 11 days before Janet Yellen says we ran out of money. So there's going to be a lot of fireworks probably early June. But after the debt ceiling has to get raised, because these people, both parties, are all about what? Power. They need to stay in power. And having a default, I would love to have what I would think would be a balanced budget amendment, Antonio. That's what it would be. I mean, imagine that. The government would have to operate its spending on only the revenue it takes in, because it can't increase the amount of debt outstanding. Ooh, what a novel idea. It's the end of the world if that happens, so we're told. But they'd have to prioritize spending. They'd have to just probably pay for defense, and they'd probably pay Social Security, Medicare, Medicaid, and interest. There wouldn't be any money left for anything else, though. But after they get the debt ceiling resolved, which I'm sure they will sometime in June, I think that's when the problem could really, you have a spike up in the stock market just as a reflexive reaction. Hey, the debt ceiling solved. And then as that TGA gets refilled and you have QT, I call it QT on steroids, because you're going to have the 90 billion per month, and you're going to have the reserve drain from the Federal Reserve, sequestering those reserves off of out of the financial system. Then you could have a problem with the stock market, because the liquidity is going to dry up very quickly.
All right. There's no other resources in your portfolio besides gold, is it?
I don't have it. Well, I have 5 sectors in the portfolio. So the sectors go from deflation, disinflation, stasis, inflation to hyperinflation, or intractable inflation. I don't, when we're in sectors 2 and 1, which is disinflation and deflation, recession, depression, I don't want to have any other resources in there, because the demand for resources, base metals and energy, goes down. And I was wrong for a little while. I looked like an idiot, but I've been proven correctly. I mean, going long energy stocks when everybody was bullish on them a few months ago was a disaster. It would have been a disaster for you. So, or even going long just oil. There's going to be a time for that, because I think on the other side of this, after this depression and recession consummates, disinflation, deflation consummates, we're going to have, as I said, intractable inflation. And then you want to load up on your base metals and energy. That's the nucleus of your portfolio. So right now you overweight gold and you severely underweight or actually go short base metals and energy, and then you flip it on the other side of that. So you really want to overweight base metals and energy. And depending what happens with nominal interest rates and real interest rates, will dictate how much gold you have in your portfolio.
How much gold do you have in your portfolio? Because you say overweight. What is that percentages?
I'm right now about 11% in precious metals.
And that's a large position for you. Like, what's the largest you'd normally go? Like, would you ever go 20,
so
25?
For my clients, I have 5%. I always say have at least 5% of your net worth, around 5%, not too much more, of physical gold in your possession. You start there. And then I toggle between 0 and 20, the allocation to gold, which includes physical gold and miners. So I'm about halfway there. And the reason that I actually sold the miners a few days ago, that we were long for about a month or two, maybe a little longer. So we enjoyed a nice ride up. I didn't want to turn that gain into a loss, just because of the machinations around this debt ceiling. You just don't know. I mean, if the debt ceiling gets resolved, you could see a big, short-term correction in the miners and in gold. And I'm going to actively trade around for that.
Okay.
I can go right back in there after that correction.
Any other position in your portfolio that's larger than gold right now?
Treasuries.
And is that, what is that, TOT, or is there something shorter?
Yeah, so as I said, it's short duration. So it's 0 to 3 months. It's 2 to 3 years. That's where most of my income is coming from. And then I have a much smaller position in going out the curve. So you think about TLT, zeros; those are the long duration bonds.
Michael, this was a very pleasant sort of rapid fire conversation. Thank you so much for investing your time in me. What am I forgetting to ask you here at the end?
Well, if you're interested in opening an account at Pento Portfolio Strategies, you have $100,000 or more, and you are a U.S. citizen, you can contact me at mpento@pentaport.com. You can call the office at 732-772-9500, or you can email me at mpento@pentaport.com.
Yes, sir. What's the lockup period?
I also have a podcast that I record every Wednesday evening. It's called the Midweek Reality Check. So I give you a lot of the data and thoughts of 38,000, 40,000 feet. 40,000 is a little high. I think it's 38,000 that you want to fly around with.
I will leave a link to that because I've been checking it out recently as well. It's on your website. What's the lockup period on money that people invest with you?
0.
Okay.
I hate that. I mean, I never, I hate Wall Street, by the way, Antonio. I used to work on stock exchange. I hate Wall Street. I think they get overpaid for doing nothing. Listen, most of Wall Street, I call them used carpet salesmen. If you're going to put money in an advisor who just always is long, basically a 60-40 portfolio, some variation of that. They're great stock pickers, and they might go, they might be 50-50. They might go 65-35 at times, but they're basically always long because stocks always go higher. You're paying them for nothing. What you need to do is to find an advisor that can be long during bull markets and out and short during bear markets. And you can identify that if you have a robust model. I mean, it's not that difficult, but you have to stick to data and math and not look at an economic philosophy. So if you're paying somebody for that, you should get out of there as soon as you can, because the most important thing to do as a investor is to avoid the 30, 40, 50% drawdowns that you see occurring with greater frequency because of the untenable situation, the artificial situation that's been engendered by global central banks and government.
You make a good point. That's something that I've recently been thinking about, said a few words about it too, is that Wall Street is not really about good performance or outperforming anybody. It's about AUM and 2 and 20. And as long as you can do good marketing and lock up people for 10, 20 years or whatever, you have $100 million, it's 2 and 20, you're taking in $2 million a year for doing nothing, even if you're not taking that 20 because there's no profit. You're living good, right, for 10, 20 years.
Right.
So
I understand. I completely get it. Yeah.
Yeah.
You have to earn your money. I mean, I made a choice early on in my life that I'm a horrible salesperson, but I'm pretty good at understanding the macroeconomic scenario. And it took me 8 years to develop this model, officially launched it, and it keeps me bullish when I need to be bullish and gets me out of harm's way when I need to get out of harm's way. And so I'll stick with that.
All right. Well, next time we talk, I'm going to hope you're going to be bullish, or maybe we talk sooner than that and you're even more bearish. But I'm going to be looking forward to our next conversation. Thank you so much for being here.
My pleasure, Antonio.